It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank in formation. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. Today, I really want to discuss annuities. And the reason that I think it's important that we do that, I know on this show we talk about the personal bank concept. We talk about, setting up high cash value policies to maximize dividends, interest. Then we set up a bank line of credit to get positive arbitrage. And then we can leverage those policies with bank money and other people's monies. And you can really, in a few years, you can get a double-digit return on your money safely, tax-free, and have lots of liquidity. That's all great. But the thing is, as amazing as that financial tool is, it doesn't fit everyone's parameters of what they're looking for. In other words, there's a number of folks out there, especially today with the stock market the way it is, then the economy and inflation, all that. They're very concerned. They just want a decent return on their monies. They don't want to lose any money, and they just want to set up a guaranteed lifetime income. And folks, that's the strength of annuities. So today I've invited Jack Ryback to join me. So Jack, welcome to the program.
Thank you, Ference. It's a pleasure to be here.
Yeah, that's awesome. And Jack and I have worked together for, a decade?
About, yeah.
About a decade.
Yeah.
So we're going to have a discussion about annuities because I've been dealing with this over 22 years, and there's still some misconceptions out there, and there's some people out there that poo-poo or discourage annuities because they're, frankly, in most cases they're selling something else.
Right.
That's the main reason, right, Jack? So, like I said, what I see, there's two major strengths of annuities, and the first is it allows the ability for somebody to grow their money, index types of returns. They can get double-digit returns in a good market year, but the principal is guaranteed. So when you talk to somebody about this, what's their interest? What's sort of the spark, if you will, Jack?
Well, I think that first thing that I would ask, and I guess we're talking to some people here who have annuities now, as well as people that are looking to get into annuities or investing their money. A lot of people are relying on their money managers, their financial experts, whoever they may be, and what most people don't realize, that person is recommending something that they may be locked into as a salesman to you because they're affiliated with one or two companies. What we do is we try to find what your goals are and find the very best annuity for you. It's so competitive out there now among the annuity companies that, for example, in many cases, and every case is individual, but in most of the cases I'm dealing with now, these companies are giving an immediate 10% bonus to people. That's how much they want your money. And we're talking about, billion-dollar companies here. We're not, your money's safe. You're guaranteed, which is also something that you need to look at. You don't want to risk a dime.
Well, let's back up on that thought, Jack, because one of the reasons, annuities kind of fell out of favor a little bit in the last few years, and particularly because the interest rates were so low.
Exactly.
And the problem was, if you understand the institution, the insurance company, with a really low interest rate that gives them a really small spread, and it doesn't allow them much ability to make any profits. So the rates, caps, and fees, which we'll talk about in a little bit further here, Jack, and help everybody understand, got squeezed. So the amount you can make off of an annuity over the last several years was more limited.
Mm-hmm.
But now the Federal Reserve has changed direction.
We're looking, and I try to be very, very conservative in talking about this. But people are looking comfortably now, and these companies are feeling very comfortable saying, oh, I would tell your clients that they're going to see at least a 6 to 8% return. To me, that's very good because some of the people that have annuities right now are making as low as 1.5% to 2%, and those are the people where the bad reputation came for annuities. It came from that.
Or the low returns, I guess you should say, recently. And again, if there was a time, like Jack saying, if you were considering one or looking into maybe getting one, now's the time because the spreads are opening up, the profitability is opening up for the insurance companies, and we're going to see better and greater returns on annuities than we've seen probably, frankly, in a decade plus.
You know, there's a lot to annuities, and if somebody does call, and I think you give the numbers and all that, but one of the things we do that I'm kind of proud of, not kind of proud, I'm proud of it, is that we look at the whole picture and really, really put somebody in the best place. It may not be the best place from a salesman's point of view as far as commission. We really don't want that, because in the long run, you want it to accomplish what you want. My personal goal is to have somebody go to sleep at night, put their head on the pillow, and know that their money's safe and doing the best it can for them. And this is one tool that can do that. Not to get too far afield, but I have some people that have a handicapped child, for example, and they're worried about leaving money for them. And there are ways to set it up, and that's what I mean by customizing it for you, where they can be guaranteed money for the rest of their life, and things like that.
And I think Jack was alluding to is we do have access to over 50 different annuity companies.
Yeah.
So that really does allow a lot of customization, personalization, like you said, rather than working with maybe just a handful or less even. But I think what I want to do here is, back up a second here, is like I started to say, my opinion is there's really two main places or purposes that annuities really, they have a strength, that this is their strength. And one is for that person that still wants to have market type of returns without the downside market risk. So speak to that for a minute.
Well, we choose, and we really look at 20 years history here to recommend if your money's going to be growing based on the Standard & Poor's or Barclays or any one of these markets. And what we do is we're finding the ones that are paying the most. And as Ferenc said earlier, it's going up. It's going up drastically, 3 times what these people have been getting. And there are people that say, well, I'm locked in with my current annuity. You're not locked in necessarily. We don't move anybody unless with the bonus they're making money immediately and guaranteed a much better chance of the higher numbers in return, without a doubt.
Right. So I would say double-digit returns in good market years, no losses in bad years. And this is the other thing about indexing and index annuities that a lot of people don't realize. Like I know I go back years ago. This was back in 08, 09 time frame, and I remember doing reviews with clients, and I would say, well, I've got some good news and bad news. And, of course, what do you want to hear first? And it seems like from a financial standpoint, Jack, everybody wants to hear the bad news first, right?
Mm-hmm.
So I say, okay, well, the bad news is you didn't make any money this year. This is back in 08, 09. Of course, the markets were dropping drastically. We're starting to see some of that these days. But anyway, I say you didn't make any money this year, but here's the good news. You didn't lose any either.
Well, that's better than a lot of people, believe me.
Exactly. So again, these companies guarantee the principal. Yes, they do have some limits to the upside, although I spoke to somebody today. There are uncapped options too, Jack.
Yes, absolutely. So as Ferenc is saying, in a good market, yeah, you definitely will see double-digit income, which I think is terrific. I think that what I come across, and I work with trusts and annuities and life policies, all of that, as Ferenc does, the big thing for me is I take a very cautious approach. I feel like most of the people I'm dealing with, some of them think they can't do an annuity because they're too old. Well, you can do it up to age 90 now in some cases. I've got some clients in their 80s that are doing it. And you know, they're not worried about money for themselves. They're more concerned about what they're leaving. In any event, it's there if you need it in any number of ways. And the double-digit income is definitely a strong possibility. Yeah.
Now, then the other part of it I was starting to allude to is on the indexing. So what a lot of people don't realize is, okay, in a down year, of course, the principal's guarantee you don't lose, which is nice, but it actually gets better than that. I say to folks with indexing all the time, look, if you're in an index product, you want one of two things to happen. You want the indexes to go up strongly so you make a nice return, or you want them to drop strongly so that you reset at a lower level. For example, again, I'm going back to my 08, 09 days, for example. I remember the S&P was, one of the indexes we dealt with a lot of time, I think it was around 1,200 or something. And it dropped at that point to like 1,000. The folks lost no money. It was a 20% drop. They lost nothing. But I said, here's the good news. You're going to reset at the 1,000 this year, And if it goes back up to 1,200, there you have a upside potential 20% capturing, or most, if not all, of that rebound, that bounce back, right?
Absolutely. No, it's a terrific tool, I think, and one that we overlook a lot because so many people, it's like people that have friends that invested in some stock, and all you hear about is, I made $8 trillion, and people think that's happening to everybody. Well, believe me, the people, it's sort of like Las Vegas and betting there. The people that you hear are great winners, you don't hear all the times they come back with their losses. And so,
well, we're hearing a lot more about some losses these days, for sure. It hasn't happened for a while, but the economy's changing, and so if you're concerned about reducing your market risk, and that, then an annuity might be a very good tool for you. And what I would do is I would encourage you to contact Jack at toll-free 866-515-6280. Again, that's 866-515-6280. But there's a second reason, that a second strength that I believe annuities have, and that really revolves around guaranteed lifetime income.
Yes, that's very, very important. I just work with somebody that for their particular needs, they're investing in life policies, bank on yourself concept, and they're putting a lot of money in there. In this case, they have 2 children. One of them is not terribly dysfunctional, but not able to take care of herself quite the same way. And so an annuity was a perfect answer for him, because when he dies, they turn the switch on, and it will automatically give that girl, in this case, a woman, I should say, she'll be a woman by that time, money for the rest of her life. And it just works beautifully for that. There are so many cases, I'm sure Ference has more than I have, where people get money, when somebody passes, they get their money, and it's gone.
Right.
They just blow it. And this is a way to really help the people that you want to give your money to, that you want to leave it to.
And like you said, Jack, other situations I've run into over the years, like, somebody loses a spouse, for example, and there was a pension check or Social Security check, and they want that income replaced if something happens. An annuity is a perfect fit for that kind of scenario. Yeah,
absolutely. And again, you can set it up in so many different ways, and that's what I like about what we're doing, is customizing everything to fit somebody's personal needs.
Well, stay tuned in the next segment. We're going to talk about some of the limitations that annuities have, because, again, they're not for everyone. They're not perfect for everyone. But, you can analyze the strengths and weaknesses yourself. So stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. So today we're talking about a subject that for some people is not the most, the most popular subject, but we're discussing annuities. I'm here with Jack Ryback. Jack, thank you for joining us today in the program.
My pleasure. A pleasure to be here.
And as we were saying in the first segment, and by the way, if you did miss it, you can listen to this or any of the previously recorded shows at yourpersonalbank.com. Go there and click on any of the previously recorded shows. They each have a topic. But why we're bringing up annuities now is, with the interest rate environment, as we stated in the first segment, with the interest rate environment increasing, the Federal Reserve increasing rates, actually annuity companies have more profitability. They have a larger spread to make more profitability. So now what's happened is annuities are starting to become more profitable again. You can actually make more money than you could even the last several, say, 3, 4, 5 years or so. So we were talking about some of the pluses of annuities. Again, their strengths of being able to grow your money safely without any downside market risk. And the other strength is creating a guaranteed lifetime income. But, Jack, what are some of the weaknesses that you see on annuity, why somebody may not want to consider one?
The biggest weakness is that if somebody invested their money and wanted it immediately after, shortly after, you can't take it back. They won't give it to you without losing a little bit of a penalty. And, so that's not positive.
Right, exactly. I mean, most annuities are roughly, a lot of times, 7 to 10 year time frames is what you want to look at. If you take it out early, there's a surrender charge typically.
And it goes down every year. So the first
Right.
year you might lose 9%, and then the next year 8 down to nothing.
Right.
So that's a disadvantage.
No question. So, but again, it's what is the, and that's one of the biggest knocks if you go online and research, or you may have heard, I hear this, I've heard this so many times over the years, is the lack of liquidity in an annuity, particularly in those first few years. But the thing is, you got to ask the question is, what's the purpose of these dollars?
Exactly.
And are you putting everything into an annuity? And in most cases, that's not the case. In other words, for example, if half your money was liquid and accessible and the other half wasn't, but it had guarantees, does that make sense for you?
Absolutely. A lot of people, when you're very young, 1 year sounds so far away. Believe me, I'm an older guy. When you get to be my age, it's gone in a blink of an eye. And what you have to realize is this money is growing and growing and growing. And if your purpose is to secure your future later and have that income long after you retire or when you retire, you have these annuities that you can just turn the switch whenever you decide. And you'll be guaranteed money for the rest of your life. It's a very, very nice investment, in my opinion, for that reason. And as Farron said, and this is important if you didn't hear the first part of the show, annuities are not what they were 10, 15 years ago. So people that have annuities, we could take that annuity and move it for you to a more competitive annuity that will give you an immediate boost of 10%, 9%, depending on age, et cetera. And this makes so much sense for people. Plus, with those annuities, the new ones, they would, or the transfer that we're talking about, they would have the ability to earn those double-digit kind of returns. Whereas right now, they're locked in. I've got people that we move every day who are barely seeing 2% return.
Right, and one of the misconceptions they have, Jack, as you were stating, is they think, well, I'm stuck with this thing. I can't touch it for another 5 or 6 or 7 years or whatever the time frame is. And the reality is, like you were saying, with these bonuses that have become more common now, again, because the companies can make more profits, so they have more money to work with.
Right.
They're doing these signing bonuses, is what I like to call them. It's just like you were a professional athlete. They're going to give you a signing bonus to bring you on, which often cases offsets whatever early surrender penalty you may have had in the old one that wasn't performing so well.
And something else, I don't know if anyone is thinking about this. We all think about taxes. If you move from an annuity to another annuity, there's no taxes. You're just transferring your money from one place to another. So don't even worry about that.
Right. It's called a 1035 exchange for those of you that want to know, and it's a non-taxable event from one annuity to another. So again, in many cases, you might have an annuity you've had for a few years that's not performing very well because it's one of the older ones now, right? And you could convert or transfer it to a better one. The bonus can offset and even then some.
Right.
The cost of leaving the old one, right?
Oh, if it doesn't,
if it doesn't, you don't do it.
We don't do it, right? Like I have one that the woman, the client, lost or would lose with the transfer. She would lose 4%, but she's gaining 10%. So she's immediately seeing a 6% boost on her money, in addition to whatever it's going to earn. So
and it also now has more ability or capability of earning more in the future, right?
Absolutely.
More benefits.
No question. No question.
So it's a better tool.
It's a better tool. And we wouldn't move it if it wasn't.
Right. It's kind of like this. I just bought a new truck, and I had a 2003 F-150. It was a nice truck. It was a Heritage Edition, all this. It was a very nice truck. And I just bought this 2020 truck. And I was driving it home last night, and I called my wife, and I said, wow, this is nice. She goes, well, you went from an 18-year-old truck to a 2-year-old truck. The technology is night and day difference. You could say the same thing about these older annuities to these newer ones, right?
Yeah, most people don't realize. They really do think they're stuck. You're not. And be careful. If you didn't hear the first part of the show, it is important to know that the financial advisor that may have gotten you into that or is advising you now, they may be limited on what they're exposed to see which annuities can offer you the kind of bonuses that we're talking about. We, as Farron's mentioned, we work with over 50 annuity companies, whereas some of these people are licensed to only work with one or two.
Right.
And that would limit you if that's all you were exposed to. So
it's kind of like the analogy I give people, Jack, is if you saw the doctor and he said you needed surgery, well, what's the first thing people do? Get a second opinion, right?
mm-hmm.
So if you contact Jack at 866-515-6280, Jack can give you a no obligation, no cost second opinion, right?
Absolutely. And I tell that to everybody that we've ever dealt with. Any questions financially, I'm happy to help you make a decision. And if you go with someone else, that's okay. Let me just check it out for you. Make sure you're in the right place. Happy to do that for you.
Yeah. And you'd be so, and like you were saying, Jack, this wasn't necessarily true a year ago or so, even less than that. But now, again, with the interest rate environment, how the Federal Reserve raised rates 0.5 point recently. I mean, it's significant, folks, the changes, and it's dramatic. In fact, I can share this. I was at a conference with one of the insurance companies just not even about a month ago, and they were saying to us, their CFO, that a month or two prior to the first interest rate hike, they were getting about 2% on their bonds. And as soon as the Fed stated that they were going to raise interest rates, they hadn't even raised them yet, they were already getting 4%. So they doubled their profits just on the idea the Fed was raising rates. Well, now they've actually raised them twice since then. It's getting better and better. So if there was a time, this is what I'm saying, we'll recommend you stay tuned in the next segment. If there was a time you either were considering annuity because you wanted some safety with some growth with some safety, or you wanted to create a guaranteed lifetime income, folks, there's probably not been a better time in my career over 20 years of looking into an annuity because of the interest rate environment. So contact Jack at toll-free 866-515-6280 for more information. Stay tuned in the next segment. We're going to discuss a few more things I think you'll find interesting, so don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and today we're discussing some, updated information on annuities that a lot of people haven't realized yet. And as we've been stating in the previous segments, the thing that's changed is insurance companies that provided annuities with a low interest rate environment only had a small spread to make a profit, so the amount you could earn as a customer, as an investor, was limited. And it's been that way for the last particularly the last 6 years at least. That is opening up, folks. In fact, I shared in the last segment that one of the companies already saying the bonds that they're purchasing, this is what they invest their money in, had already doubled, and this was a month or two ago, and the Fed's just raised rates another 0.5 point. So my point is, as the Fed aggressively raises and increases rates, the profits that we're going to see with annuities will continue to increase. So if you ever were looking or considering an annuity to grow your money safely, no downside market risk, or create a guaranteed lifetime income, now is the time. And if you have one, I have Jack Ryback with me. Thank you for joining us again, Jack.
My pleasure.
If somebody has one, maybe they've had one 2, 3, 4, 5 years or longer, what would you recommend for them?
I would recommend that they call, because we will investigate which of the newer companies that are offering big bonuses to join them would make sense for you. For example, the majority of people I'm dealing with nowadays have had them from 10 years around 10 years, some longer, some shorter. But moving that account, they need to know, because so many of these people think they're locked in. You're not locked in. We could move you to a company that's offering these bigger percentages to join, and it makes sense for you, and we could do it. Now, in some cases, you may lose money, meaning a 3% penalty for moving your money, depending on how long you had it. It doesn't matter, because if you're getting 10% and it's costing you 3 or 4%, you're still making 6 or 7% immediately, and that has nothing to do with the bigger return on your investment. Anyway, you're gonna do a lot better than that 2% you're making now.
Yes, and so it's in essence you're getting a new and improved product, and they're paying you a signing bonus to move it over there. So
right.
you're benefiting immediately and in future years.
And something I'd like to add too, if you deal with, Ference gave you the numbers. I know how we work our company. If you deal with us for any of these annuities that we're talking about, you don't have to wonder what's happening on the market or which annuities are going to offer these kind of bonuses again. That's what we do. And we would call you. Everybody should be talked to at least once a year. And I don't know if a lot of these financial advisors are doing that. I'm not saying anything against anybody, but again, those people may be locked in with a couple companies that maybe aren't doing this, and they don't let the client know about it. We stay on top of that, and that's why we think now is a good time.
Yeah, contact us at toll-free 866-515-6280. Jack will be happy to talk to you and share with you. He's a nice guy, right?
I've been told.
Yes, it's funny. Like I said, working with Jack this past decade, the one thing I can say is, from a client standpoint, I hear this all the time. They say, Jack's just such a nice guy. I really enjoy talking to him.
Well, that's nice to hear. I'm also much better looking on the phone.
There you go. So anyway, like I said, our whole point is really, like I said, what put behind, you kind of set aside if you have some negative ideas or connotations about maybe what you've heard about annuities. Things are dramatically changing. And changing very quickly, frankly, thanks to the Federal Reserve. And the number one rule of investing, isn't it buy low, sell high?
Yeah.
Well, annuities have kind of been on a low ebb, certainly, no question, for the last 5+ years. And now they're rapidly moving upwards, and they're going to be stronger and stronger going forward because of this.
And what's important is none of this is going to cost you anything. It's a question of taking money. It's your money. You have it invested with these companies. We're going to just move it to another company where you're going to get a bonus and a potential for a much, much better, much higher return.
And just so you know, obviously, we mentioned working with over 50 companies, Access. They're all A-rated.
Oh, yeah, you're talking big companies.
Yeah. So you're talking about A-rated, your money's safe, it's insured, you have guarantees. Again, if you're looking for that consistency, that steady, that growth, potential upside, or that guaranteed lifetime income, we were stating before the weaknesses in the last segment. I mean, if you're looking for, that tremendous upside, you're going to make 20, 30% in the year. No, that's not where an annuity shines. But if somebody wants that they have different purposes or different goals, or as I like to say sometimes, if you have a certain portion of your money safe with guarantees and it won't go down, doesn't that allow you to be more aggressive on the other funds if you want to take a shot?
It's really finding what makes you happy.
Right.
And that's really what we're trying to do.
Well, lets you sleep at night. So we're going to encourage you to stay tuned in the last segment. Jack's going to stay with us, and I'm going to share a little bit more about this leveraging and how we can, you could actually use an annuity with this too, to maximize your return. So stay tuned in the next segment. Don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and we've been discussing the updated information on annuities on this show because, again, as we've stated several times, if you haven't looked at an annuity recently or you are considering it, now would be the time because the profitability on them is definitely on the upswing. The companies have more ability to make profits because of the increasing interest rate environment. And, you want to buy low, sell high, right? So if there was a time you wanted to look at setting up a guaranteed lifetime income or investing and getting index returns with no downside risk, an annuity would be a good place to look. And like I said, as we've been sharing, I'm going to encourage you to contact Jack at toll-free 866-515-6280. Thank you for being with us today, Jack.
My pleasure, Ference.
Now, what I want to touch on, though, is several of you have been listening in the last several weeks. And I've been talking about this leveraging with the life policies and why I want to touch on this right now, because you have more, if you do this leveraging, you'll have more and more money available to do with whatever you want with it. You could use it to spend it or buy things, but you also can use it to invest in anything you want to. And whether that's stocks, bonds, mutual funds, real estate, cryptocurrencies, annuities, it doesn't really matter. But you're going to have more money. And like I said, the bottom line is Anybody that's listening to this program for any period of time knows that the personal bank concept is all about setting up a high cash value policy. And currently, we have fixed rates of like 5.75, which, by the way, folks, those are on the upswing also. So this is another part where we're excited about the timing, because with the increasing interest rate environment, the life companies also have more profitability. They're making more as we go forward. I already shared in the previous segment, one of them already doubled their profits in the last few months on their investment, their new investments that they're doing. And that is going to continue to increase because they're interest rate sensitive assets. So these dividends that we're going to see going forward, we're going to see increases, okay? And depending on how high this inflation goes, it could get very interesting. But we're also blending it with the IULs, the index products, like we shared, just like with the index annuities, where you have the potential, the double-digit potential in the good years and no downside in the bad years. And with the way this year's gone so far, having no downside is really powerful. And so if you blend the two, it means you do some of both. You always have that steady Eddie consistent growth along with the potential for those bigger bumps on the better years. And all of it's principal guaranteed, and you never lose any money on any of it. But to take, and then the next step, of course, that's step one. We set up these policies to earn interest, to earn dividends, right? To grow our money safely with guarantees, tax-free, and lots of liquidity. But then we set up, when you want to access funds, we can set up a bank line of credit to access them, and the banks typically charge less. As I stated, we now have banks that offers 2.75% interest. So on the fixed side, that's a 3% positive arbitrage, okay? On money you spent, that's pretty powerful, but it gets better than that. Taking it to the next level is leveraging, and we leverage bank money. So in other words, let's say you funded $100,000. And again, I'm not using, you don't have to do that amount. I want you to understand, add a zero, take away a zero. Doesn't matter. The principle works the same. But I'm going to use that as a simple, nice, simple round number. You fund $100,000 to earn dividends. The fixed side is going to be at 5.75 currently, and we fully expect that to increase as we go forward because of the interest rate environment. The index side will do whatever the typical indexes do. Historical averages are somewhere between 6 and 8%, just so you know, long-term historicals. So if you're making 6, 7, 8% on your money, you decide to access it, again, getting charged 2.75, you keep the difference. Our average client is making about around 4% positive arbitrage on money they spent. But you fund that 100,000, here's where it gets better. The bank the next year will fund the next 100. And they're going to charge you the 2.75% interest. But if you're making 6, 7, 8% on that money, you get to keep the difference, right? And the difference is on money the bank contributed, not you. So folks, how would you like to make interest from the banks instead of paying interest to the banks? This is what's so powerful about this leveraging idea, because if you think about it a minute, if you're making 6, 7, 8% on the 100,000 you contributed, let's say, and then the next year the bank contributes the next 100, and let's say your positive arbitrage is going to be probably 3, 4%. Well, now your rate of return on your money is approaching 8, 9, 10%, isn't it? In other words, if you made 6 on the first 100 you put in, and you make 3 on the next 100 the bank put in, that's a 9% rate of return on your money, right? Because you put the first 100 in, the bank put in the second 100. But guess what? The bank's going to continue funding that for the next 20, 30 years. And folks, this works for folks all the way up, like Jack was saying. I have successfully funded folks like this up to age 79, just so you know. So if you're funding 20, 30 years, the bank is, think about it. By the third year, the bank's funding the next 100. Your ROI, your return on investment, the first year in our example was 6%, then 9, now it's 12, isn't it? And the following 15 and so on. We have many clients, typical client situation where they're making 20% plus average rate of returns on the money they contributed because they only contributed the first year, that first 100, right? So my statement, I make this to people all the time, is real simple. Would you rather make 6, 7, 8%? Let's keep it at 6. So you want to make 6% on 100 grand? Or would you rather make 3% on $1 million? Because in 10 years, you put in 100, the bank put in 900, $1 million have been contributed into this high cash value policy that's earning 6, 7, 8% with guarantees, tax-free. Okay? You start to see where I'm coming from? And that's just after 10 years, folks. In most cases, these are funded 20 and 30 years. Again, you put the money in the first year. You kicked it off, so to speak. You got this thing off and going. Now, the question I get all the time is, well, that's awesome, but almost too good to be true. No, it's not. And here's why. What you're doing is you're actually investing similar to how a bank, you're operating like a bank operates. And let me explain. So if a bank you put $100,000 in a bank, in a checking, savings, CD, whatever it is. Okay, what does the bank do? Well, they're going to turn around and borrow against the Federal Reserve 7 to 9 times what you deposited. Cheap money, right? They're going to borrow from the Federal Reserve at a low interest rate. So that means the bank now has $800, $900, or maybe up to $1 million available to loan out, doing car loans, home loans, and various things, right? And we all know car loans and interest on car and house loans and things is much higher than what the banks are paying us on our deposits, right? In other words, if they do a 5% car loan and they're paying you 1, if you're lucky, they're keeping the difference, the 4%, right? But they're making the 4% on $1 million, and you gave them $100,000. The average bank in the United States makes around 30-40% gross profits annually. In Arizona, I'm on the bank board. I saw this. This is public records. I saw we were meeting recently. The average bank in Arizona last year made about 21% net profit. So in other words, they made 30-40% after their cost of employees, buildings, and various things. Their net was about 20%. Folks, if you do this, you probably don't have brick and mortar building or employees, right? Now, some of you do, business owners. But you see what I'm trying to say is this: if your money is not having to support, your investing is not having to support a business. So you can see where you can get into very, very strong double-digit returns consistently with safety by safely leveraging bank money. You're making money from other people's money. And folks, I'm going to tell you that is one of the biggest keys to be financially successful. Anyone who's, the wealthy understand this, okay? Often understand this. You're operating like a bank does. You're operating like the wealthy do. You're using other people's money, safely leveraging it with guarantees to make more. And why I'm so excited about this, and I've been sharing this now for a while, is we're having clients, we're having people do this, and their financial trajectory for them and their family and their business is changing. And I mean, folks, changing dramatically. We're not just talking about putting some money away to let it invest. Hey, it makes money, it doesn't make money, hope it works out. Sometimes it does, sometimes it doesn't, right? We're talking about a system that's consistent, it's steady. We have over 70 years of history showing where you're consistently positive every year. And the argument about whether I should go you talk about the blend on the fixed steady eddy versus the index is a moot point. We don't really care which of those outperforms the other. We just want the mix and the blend because each has strengths, each has weaknesses. The steady eddy, consistent one, the strength is it is steady and eddy and it pays every year. The weakness is it's a turtle. It changes slowly. It doesn't adapt to changes quickly. The index one has the ability to, boom, do a couple nice, strong double-digit return in a year, a good market year. Heck, we have options with uncapped options with a small fee where it can make 20, 30% or more even in a really good year. Won't lose in a bad year, so the principal is guaranteed, just like the annuities we were talking about in the previous segments, but with even greater potentials, okay, just so you know. It's the mix, and it moves. It's more nimble. It moves quicker. So you want the balance of the two. So if they average 6% combined, who cares which one outperformed the other? Because you're leveraging that 10 times, 20 times with bank money. The last question I get on this all the time is, why would banks do this? Why would they loan this out? I had this question today, in fact, from a very successful business owner. And I said, here's the thing. These are fully collateralized loans. They are borrowing against the cash value in these policies these insurance companies are paying that are guaranteed. They're growing each and every year. So the cash is there. The bank knows the cash is there. This is considered Tier 1 capital by FDIC. There are only 3 types of money it's cash, cash equivalents, and cash value in a life insurance policy is considered Tier 1 capital by FDIC, which is the safest capital a bank can invest in. And when the economy goes south, when things aren't going so well, guess what banks do? They start fleeing to safety just like everyone else, right? In fact, back in 08, 09 is a great example. A lot of people remember banks weren't lending for mortgages and car loans and things like that, right? But guess what they were lending for? Cash value life insurance. It was Tier 1 capital, folks. It was flight to safety. We had no problems in those days with banks lending. In fact, we currently have 12 banks right now that will lend to these different policies. And we're working on even better. And by the way, if you've been paying attention to the show, you notice the interest rates have been going down on these lending rates, while the general interest rates in the country have been going up. Why? Again, banks are concerned about the economy and inflation and what's going to happen in the future also. So they're moving towards more safety. So this is getting easier and easier and better, folks. So as Jack and I were stating in the first few segments, if there was a time you were ever going to look at an annuity for an annuity to be profitable, now's the time, because interest rates are climbing and there are better products available with better bonuses, better upside potential, and it makes sense. I'm going to say the same thing to you for the personal bank concept and a cash value life policy. They're only getting better because these are interest rate sensitive assets. Buy low, sell high. We all know that, right? The rates of returns on dividends have been on the low side, with annuities have been on the low side for the past decade, particularly in the last 5 years or so. They are strongly on the upswing and are going to be getting better as we move forward. Again, if there was ever a time, this is the time to do it. Jack, again, I want to thank you again for joining us today. He got to sit here and listen for a bit.
Oh, this is exciting. I like this.
Yes. So if you want to contact us about looking into an annuity to invest money safely and or create a guaranteed lifetime income, call Jack at toll-free 866-515-6280. If you want to talk to me about the personal bank, leveraging leveraging bank money safely to make more, then contact me at yourpersonalbank.com.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.